Hello there, and a very warm welcome to this explainer. I'm Nancy, and today we're going to sit down together and demystify a concept that might sound a little intimidating at first, but honestly, it's wonderfully simple once you get the hang of it. We're going to talk about understanding market valuations. My goal today is to gently hold your hand through this journey so that by the time we wrap up, you'll be able to look at your investments and your entire financial future with a real sense of quiet, absolute peace of mind.
Okay, so let's dive right into the big, essential question. It's the exact question that keeps so many of us everyday investors tossing and turning at night, right? You watch the news, you see the market hitting record highs, and that little voice in your head whispers, wait, is it too late? Am I buying at the absolute top? Well, let me tell you, it is completely natural to feel that way. We all just want to make sure we're putting our hard-earned money to work at a fair, reasonable price. Usually, to quiet that fear, folks look straight at the normal price-to-earnings, or PE, ratio. You've probably heard of it. It's the most common tool out there. Basically, it calculates a market's value using only the previous single year of earnings. But we're going to explore why relying on just one single year of data to make your big, life-changing financial decisions might actually be a little bit misleading. The fundamental flaw here is that a single year can be incredibly noisy. Think about real life for a second. One year, you might get a massive, unexpected bonus at work, and the very next year, you might be hit with a surprise medical bill, right? Well, businesses operate exactly the same way. One year's profit can be artificially supercharged by a sudden economic boom or terribly dragged down by a quick recession. It just doesn't give us the true, lasting story of that business. And that is where Nobel laureate Robert Shiller's incredibly elegant solution comes in, the CAPE ratio. It stands for Cyclically Adjusted Price-to-Earnings Ratio. I actually like to think of this tool as a gentle, reassuring hand that just calms all the frantic noise of the market to give us a much clearer picture. Instead of looking at one chaotic year, it looks back at 10 full years of data and brilliantly adjusts it for inflation, giving us a really solid baseline to work from. The difference really is night and day. The normal PE is jittery. It's constantly reacting to 1 year of really noisy data. The CAPE ratio, on the other hand, calmly breathes through 10 full years of smooth, inflation-adjusted reality. So what we're doing here is happily trading that short-term, stressful noise for long-term, reliable clarity. Now, the math behind the scenes is beautifully simple. Honestly, there's absolutely no magic here, just clear, comforting logic. Step 1, we just take the current market price. Step 2, we gently gather the average real inflation-adjusted earnings from the last 10 years. And step 3, we simply divide the price by that lovely 10-year average. That's the whole shebang. Let's bring that to life with a really quick real-world example. Say the Nifty index is sitting at a level of 25,000, and let's say we calculate that the 10-year inflation-adjusted earnings average is 1,000. Well, 25,000 divided by 1,000 means our CAPE ratio is exactly 25. It's just a single, clean number, but it tells a whole decade's worth of stories. If you ever feel overwhelmed by all this financial jargon, just think of it like buying your favorite neighborhood shop. You would never, ever hand over your life savings to the owner based on one incredibly lucky year where they happen to sell out of everything, right? No. You'd sit down, ask to see their books, and you'd want to look at a full decade of reliable profits before making that kind of commitment. And really, that is exactly what the CAPE ratio does for the stock market. Think of these valuation zones as our very first map for navigating the landscape. A CAPE below 15, that means the market is relatively cheap, a beautiful, rare bargain. 15 to 25 is what we call our comfortable, fairly valued zone. Now, 25 to 35 means things are starting to get expensive, and anything above 35 is very expensive territory. Having these simple boundaries is so helpful because it protects us from acting entirely out of pure emotion. So, the absolutely crucial thing to remember here is what this tool is actually meant to do. The CAPE ratio is not a panic button for tomorrow's trading. It simply cannot tell you what the market will do next Tuesday. But as a long-term tool, it acts as a steady, reliable compass. It is highly useful for managing your expectations for returns over the next 7 to 15 years. When we look back historically, it shows us a really reassuring, consistent truth. When the CAPE is very high today, it gently warns us that future 10-year returns will probably be a bit lower. But when the CAPE is very low, it's signaling that buying patiently right now usually leads to much higher, happier returns down the road. It essentially helps us spot those truly attractive long-term opportunities, completely stress-free.
And this brings us to a concept that I hope beautifully builds your confidence. CAPE is a valuation tool, not a timing tool. You don't look at it, panic, and suddenly sell everything. Instead, if the CAPE is extremely high, wise investors just start keeping a little more cash on the side. It's all about gently preparing your portfolio for future opportunities, rather than trying to perfectly time your entry and exit points.
I love thinking of it like a simple, easy-to-read thermometer in your living room. It basically tells us the financial weather. A low CAPE means the market is cool and inviting. An average CAPE means the temperature is wonderfully comfortable. And a very high CAPE, well, that simply tells us the market is running a bit hot. So maybe we should take a little step back and cool off.
So now that we deeply understand the concept, let's step out of theory and into reality. Let's check the temperature of our own beautiful Indian market today, right here in June 2026. What exactly is the thermometer telling us about the environment we're investing our money in right now?
At first glance, if we just look at the normal one-year PE, our market actually looks quite reasonably priced. It's sitting around 20 to 20.7, which is actually below its recent historical median of 22 to 23. So the surface level thermometer tells a very comforting story. But we know a little better now, don't we? We know we need to look just a little bit deeper.
Because we have to remember this crucial piece of context. India is an incredibly dynamic, fast-growing economy. Since we have been growing so powerfully over recent years, our 10-year average naturally includes older, much smaller earnings from the past. And when we average those older, lower numbers with our bright, high current earnings, it naturally pulls the math up just a little bit.
Because of this amazing dynamic growth curve, when we do the hard work of actually adjusting the Nifty's earnings for inflation over the entire last decade, we find that the true Nifty CAPE is estimated to be right around 26. So 26 is our true anchor number for today. Now, looking at our tailored frameworks specifically for the Nifty, we can see exactly where that 26 gently places us. While 20 to 25 is fairly valued, at 26, we are just dipping our toes into the moderately expensive category. Our current reality can be summed up perfectly in this single thought. We are not getting a massive discount at the moment, but we are absolutely, entirely, not in terrifying bubble territory either. It is a completely normal, incredibly healthy place for a strong market to reside. If you are someone who is patiently accumulating index funds like Nifty Bees, this is exactly what you need to know. A CAPE near 26 simply means you should align your expectations. Your long-term returns moving forward will likely be steady and moderate. Perhaps not quite the spectacular rapid-fire gains we saw from 2020 to 2024, but you know what? That is perfectly okay. So here is your personal, peaceful action plan. Because we are sitting comfortably at 26, right in that middle 20 to 30 zone. The absolute best, most nurturing thing you can do for your future wealth is simply to continue your normal sips without any stress. You are investing normally. No panic, no aggressive gambling, just a steady, staggered, loving commitment to your financial future. It's also deeply reassuring to understand our place in the global picture. In slow-growing developed markets, a high CAPE can be really alarming. But because India's economy is growing so powerfully and consistently, a CAPE of 25 to 28 is generally much less alarming here. Our fast growth supports that slightly higher valuation beautifully. To summarize our entire current environment in one breath, we are sitting very comfortably in a mildly expensive but completely reasonable market. We are not overvalued. Your investments are safe to continue growing at a steady, reliable pace. As we wrap up our time together today, I want to leave you with this final, gentle question to guide your personal journey. The market is fairly valued today. So ask yourself, are you investing for the panic of next week or for the beautiful, wealthy reality of your next 10 years? Thank you so much for letting me, Mancy, walk through this explainer with you today. Keep investing, and please take beautiful care of yourselves.